Hey everybody, good afternoon. It's Ray Schoonover with S2O Capital Management. Wanted to offer just a brief trading idea that highlights one of the other tenets of dealing with volatility and ways to make a profit. And I thought I'd highlight a trade here that's an earnings trade, and it is on Tesla. Tesla is due to come out with their earnings after the bell here in just a little over an hour. Tesla's up $6.40 today at $306.32. So I wanted to give you a brief kind of look at what we look at when we're looking at a catalyst like an earnings trade that typically will give us a benefit of a higher implied volatility. If we look at the volatility chart here, it was really high back 30 days ago, and it's come off a little bit, but we're still over 50, which is a nice place to be at 64.539%. We see the price action in terms of how it's trended here. So with earnings, we're going to see how this works, but what I want to do is show people how we can make trades around volatility. Of course, directional trades are just buying or selling and looking for it to either go up or down for a profit. With volatility trades, we can deal with range-bound circumstances. And so what I've looked at here is if we look at the dotted line we see on either side, this shows us that 68% of the time subset prices should fall in between there. We're giving ourselves 22 days on this, which is better than doing it for example, day after tomorrow, Friday's expiration. Even though we would get immediate gratification in that, we wouldn't have room if somehow something went a little wacky on us. So in any event, we're looking, the options market is pricing in a move up to about 355 and down to about 255. So we're going to be just on the outside perimeter of that, a little bit more than on the puts that we're selling, the 245s, and we're selling the 355s. What we're doing here is, if you'll notice, we're buying a call 15 points out. So for 10 contracts, that's $15,000 in buying power that we're risking. Actually, we're risking that. If the stock went to 1,000, we lose $15 on that. If it went to 0, we'd lose $15 on that. We're making $2 on the trade, is what it looks like, and we're getting a 76% chance that we're going to collect that $2. So that's $200 for a contract. For 10 contracts, that's $2,000. We're risking $15,000 to make two. $2,000 divided by $15,000 gives us a 86% type of probability. And so we are looking at a trade here that tries to put probabilities on our side. And so what I'm going to do is I'm going to show you next how we go in and we line this up. So if we're looking at the midpoint of this now is 210. Let's say we're going to do 10 contracts and not 50. If we go in, that's controlling 1,000 shares. Of course, it's a hugely priced stock, so that's why we want to do an iron condor, which is the name of that. That's a defined risk trade where we're selling the call but buying a call further out to define our risk. And as you may recall from the diagram, I'll just go back to the diagram. We're defining our risk at 15 points, 355 to 370. We're stopped out with any further upside potential loss above 370. So $15,000 on 10 contracts is our risk. If we go in here and we're doing 10 contracts and it's bumping around, it's giving us a better price. 219 is what we can do now. And so if we go in here and we check our margin risk, we're looking at $15,000. So $15,000 is what we have to put at risk in this trade to end up making $2,190. In any event, after the earnings announcement comes this afternoon, and depending upon where this trades, if it trades within this range, which was where the probabilities tell us it's going to, we will end up making money on the trade. So I'll check back with you later, and we'll see how we did. Good luck, good trading. Call me with any questions that anybody ever has. My phone number is 338-1515, or you can email me at ray@stlcapital.com. Thank you. Bye.